price is moving sideways for days, maybe weeks. It goes up a little, you feel a flicker of hope and you buy. It immediately drops, hitting the invisible stop you had in your mind. The loss stings. Frustrated, you sell, convinced it's going lower. As if on cue, it snaps back up, leaving you behind. You feel trapped, whipsawed by a market that seems to be doing nothing but stealing your money in small, agonizing increments. This isn't a broken market. It's a market doing its job, and right now its job is to test your patience to its absolute limit. You are inside what is known as a trading range, and this is the most dangerous place for the uninformed mind. It feels like a cage, but for the professional it's an arena of observation, a place where the next great move is being advertised in plain sight, if you only know the language. A trading range is a pause, a period of equilibrium where the forces of buying and selling have reached a temporary stalemate. But this is not a period of rest. It is a period of intense, quiet conflict. Picture a tug of war. For a while, neither side can gain an advantage. The rope barely moves, swaying back and forth over the central line. This is the price action you see on your screen, choppy and meaningless to the untrained eye. However, beneath the surface, one side is slowly tiring out the other. One side is methodically accumulating strength while the other is exhausting its resources. This period of balance is what market technicians call a cause. A fundamental law of the market is that every significant move, every trend, must be preceded by a cause. The longer and more hard-fought this sideways battle, the more powerful and sustained the eventual move will be. The trading range is the market-building energy. It's coiling a spring. The longer it coils, the more explosive the release. The primary function of a trading range is to facilitate the transfer of shares from one class of operator to another without causing a major price disruption. Large institutions, the smart money, cannot simply buy or sell millions of shares at once. An order of that size would instantly move the price against them, ruining their average entry or exit price. If they want to buy, a massive market order would cause the price to skyrocket, forcing them to pay far more than they intended. If they want to sell, a huge sell order would trigger a panic, and they would be forced to liquidate their position at ever-worsening prices. Therefore, they must operate with stealth. The trading range is their camouflage. Imagine a large operator who, after extensive research, has decided a stock is undervalued and wishes to acquire a massive position. They cannot announce their intentions. Instead, they begin to buy in small parcels. They buy when the price drifts down to the lower boundary of this forming range. This buying provides a floor, a level of support below which the price seems unable to fall. But as their buying gently pushes the price up toward the top of the range, they stop. They may even sell a small amount to push the price back down, creating the illusion of weakness. Why? Because they need the crowd, the uninformed participants, to sell them more shares. They feed on fear and impatience. The retail trader, seeing the price fail to break out, becomes discouraged and sells their shares, often at a small loss or break even. These are the very shares the large operator is quietly absorbing. This process is called accumulation. It is the methodical, patient gathering of stock at a favorable price. Conversely, imagine that same operator now holds a massive position, and their analysis suggests the stock has reached its peak value. It's time to sell. They cannot dump their entire holding at once, so they begin to distribute it. As the price rises to the upper boundary of a new trading range, fueled by public excitement and positive news, they begin to sell. They feed the public's appetite for the stock. Their selling pressure acts as a ceiling, a level of resistance the price cannot seem to penetrate. When the price drifts back down, they stop selling, allowing it to recover. This encourages the crowd to buy the dip, believing the uptrend will continue. The public is buying with enthusiasm, while the institution is methodically, quietly selling into that strength. This is distribution, The trading range in this context is a mechanism for the smart money to unload its inventory onto a willing but uninformed public before the price inevitably falls. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts is not about learning tricks. It is about understanding the unchangeable logic of the market, a logic that is on full display within every trading range. So how do we begin to see this battlefield with clarity? First, we must train our minds to visualize the structure. Picture a rectangular box drawn on a chart. The top line of the box is resistance, the ceiling. The bottom line is support, the floor. The price is a ball bouncing inside this box. The middle of the box is the most dangerous area. It is a zone of maximum confusion and random noise. Amateurs love to play in the middle of the box, buying a little rise, selling a little dip. They are guaranteeing themselves small losses and emotional fatigue. The professional operates only at the edges. The edges are where the important information is revealed. Your first task is to stop participating in the chaos and become an observer. Your job is not to guess which way the price will go next. Your job is to watch how the price behaves when it approaches the boundaries of this box. When the price comes down to test the floor, what happens? Does it hit the level and immediately get bought up with force, leaving behind a long tail at the bottom of the price bar? This is like a defender on a goal line refusing to let the ball pass. It shows buyers are present and aggressive at that level. Or does the price languish at the floor, showing little buying interest, looking heavy and weak? That tells a very different story. Similarly, when the price rallies up to the ceiling, observe its character. Does it strike the resistance level and get slammed back down, leaving a long tail at the top? This is a sign of aggressive sellers. They are defending that price. This is evidence of supply entering the market. Or does the price press up against the ceiling, refusing to pull back, absorbing all the selling pressure? This is a sign of underlying strength, a signal that the buyers are relentless and may soon overwhelm the sellers. Volume is your next critical tool. Volume measures the amount of activity, the intensity of the battle. In a healthy accumulation range, you will often see volume expand as the price tests the support level and rallies away from it. Conversely, the volume will tend to dry up as the price drifts back down. This tells you there is enthusiasm for buying, but a lack of interest in selling. The sellers are becoming exhausted. In a distribution range, the opposite is true. You'll see high volume on the rallies to resistance that fail and low volume on the dips to support. This shows there is significant energy being expended to sell the stock, but little professional buying interest on the dips. The buyers are becoming exhausted. This interplay between price action and volume is what we call effort versus result. A large amount of volume, effort, that fails to push the price through a key level, lack of result, is a massive red flag. It tells you a powerful force is absorbing that effort. The action plan for navigating a trading range is rooted in one single powerful concept: patience. You must wait for the market to declare its intention. Your highest probability trade is not gambling inside the box. It is positioning yourself to act on the conclusion of the battle. The first step is to define the territory, clearly identify the support and resistance levels that contain the price action. These are your lines in the sand. Do not act until one of them is decisively broken. The second step is to analyze the character of the action within the range, just as we discussed. Is it showing more signs of strength or weakness? Is the volume confirming accumulation or distribution? You are building a case like a detective gathering evidence. You are not trying to predict the future. You are assessing the present balance of power. The third and most crucial step is to wait for the breakout or breakdown. For a bullish scenario, this is what Wyckoff called jumping the creek. The creek is the resistance level, the top of the box. A jump is a decisive price move that closes clearly above this level. This is your setup. But it is not yet your trigger to act. The amateur jumps in on the very first sign of a breakout, driven by the fear of missing out. This is often a fatal mistake. The professional waits for confirmation. After the price jumps the creek, it will very often pull back to test that old resistance level. This level should now act as new support. Imagine a person jumping over a small creek. They land on the other side and pause to make sure the ground is firm before they continue running. This is what the market does. This pullback and successful test of the old ceiling is your trigger. It confirms that the balance of power has shifted. Buyers are now in control of territory that was previously held by sellers. Your entry is placed as the price begins to move up again after this successful test. Your protective stop-loss order is placed on the other side of that line, back inside the trading range. If the price were to fall back into the box, your entire thesis for the trade is invalidated, and you must exit with a small, manageable loss. The logic is clean. The breakout was supposed to signal a new trend. A failure to hold above the breakout level means the signal was false. This disciplined approach protects your capital from the most common trap, the false breakout. The same logic applies in reverse for a bearish scenario, or a breakdown. This is called falling through the ice. The ice is the support level, the floor of the range. A decisive close below this level is the setup. The price will often rally back up to test the underside of this broken support, which should now act as new resistance. If the price is rejected at this level and begins to fall again, that is your trigger to enter a short position. Your protective stop is placed just above that level, back inside the range. If the price manages to climb back into the box, the breakdown was a false signal, and you exit the trade. Now we must consider the variations, the scenarios where the market attempts to deceive you. The most common is the false breakout, which in Wyckoff terms is called an upthrust. An upthrust is a price probe above the resistance of a trading range that quickly fails and returns back inside the range. This is an expertly designed trap. It is engineered to prey on the emotions of the crowd. As the price pushes to a new high, it triggers buy orders from breakout traders. It also creates a sense of panic and fear of missing out in those who were waiting on the sidelines. Just as the buying reaches a fever pitch, the large operators who engineered this move unload their shares onto this wave of excitement. The sudden influx of their large supply overwhelms the buyers, and the price collapses back into the range, trapping all the new longs at a poor price. An upthrust is not a random event. It is a sign of profound weakness. It is a deliberate test for any remaining demand above the range, and its failure proves that sellers are in dominant control. When you see an upthrust, your entire perspective on the trading range must shift. What you may have thought was a period of accumulation could now be revealed as a sophisticated process of distribution. The correct action after witnessing a confirmed upthrust is not to try and buy the dip. It is to look for opportunities to sell, anticipating a move down to the other side of the range, or even a complete breakdown below it. The bullish equivalent of an upthrust is called a spring. A spring is a price move below the support of a trading range that quickly reverses and closes back inside the range. It serves a similar but opposite purpose. It is designed to shake out weak holders and hunt for stop-loss orders. As the price breaks the support level, it triggers a cascade of automated sell orders from traders who had their protective stops placed just below the floor. It also induces panic selling from those who fear a major collapse. In this moment of maximum fear, the large operators step in and absorb all of this selling with their massive buy orders. They are buying at a discount from panicked sellers. Once the selling is exhausted, the lack of supply allows the price to reverse sharply and rally back into the range. A spring is a powerful sign of strength. It is a final test of supply below the range. By absorbing all the selling and reversing, the market has shown that the path of least resistance is now to the upside. After a successful spring, the professional trader is not scared. They are alert. They see this not as a danger, but as an opportunity. It is often the final event that precedes a powerful and sustained upward trend. The correct action is to look for a low-risk entry point, with a stop placed just below the low of the spring. The market has shown you its hand. What if the range simply continues for much longer than you anticipate? This is a test not of your analytical skill, but of your emotional fortitude. The market does not operate on your schedule. The longer a stock consolidates in a trading range, the more shares are changing hands, and the more energy is being stored for the subsequent move. A range that lasts for a year can launch a trend that lasts for several years. A range that lasts for a few weeks might only produce a trend that lasts for a few months. The duration of the cause is proportional to the magnitude of the effect. Your impatience is your greatest enemy. Forcing trades out of boredom inside a prolonged range is a guaranteed way to erode your capital. The professional embraces the quiet. They understand that no action is often the most profitable action. They wait. They observe. They allow their plan to unfold, knowing that the market will eventually tip its hand and provide a clear, low-risk opportunity. Trading is a game of calculated waiting, not frantic action. In summary, the behavior of price within a trading range is the most honest language the market speaks. It is a transparent window into the battle between supply and demand. It is where trends are born and where they come to an end. The crowd sees this sideways movement as noise and frustration. They lose money by overtrading in the middle, by getting trapped in false breakouts, and by panicking on shakeouts. The professional sees it as a process, a cause being built. They use the boundaries of the range as their guide. They analyze the character of the price and volume to build a logical case. And most importantly, they wait with immense patience for the market to signal its true intention with a confirmed breakout or breakdown. This is not about being a genius or having a secret formula. It is about understanding the simple, timeless logic of the market and having the discipline to act only when the odds are overwhelmingly in your favor. Understanding these phases is the first step toward aligning your actions with the market's true rhythm. The trading range is not your prison, it is your classroom. It teaches patience, observation, and the crucial skill of letting the market come to you. If you wish to deepen this understanding, to learn how to read these stories that the chart tells every single day, stay with us. The journey to market mastery is a marathon, not a sprint, and it begins with a solid foundation.